Welcome to our third quarter video update for the year 2023. I am joined by my colleague, Janet Kimsing, and I would like to welcome back Glenn Murray, Chief Investment Officer and President at Capstone Asset Management.
Hi, Mary and Janet. It's good to be here again.
Glenn, we're happy to have you back. And as you know, we always have a lot of questions for you, so let's jump right in. It's an exciting time at Capstone, considering Kinvest is nearing its very first call. Are you able to share any insight as to why Africa is a great investment?
Yeah, it is, Janet, and we are excited to provide this first Capstone Impact Fund in partnership with Kinvest Venture Partners. Together, we are looking to factors within Africa that support our vision of making a difference in rural communities through an overarching economic impact. I'll focus on two aspects of this new strategy that we are excited about and which we believe makes Africa, and in our case, specifically Rwanda, a great investment. Africa has a unique growth trajectory at this point in time that has the opportunity to have a significant impact over the coming decades. For example, by 2050, Africa will have 2 billion people, half of which will be in the rural areas. By 2100, 13 of the 20 largest cities in the world will be in Africa. And Africa is young, with an average age under 20. It's these types of factors that support a strong tailwind to growth in the coming decades and provide the platform for investments going forward. Secondly, the agricultural sector we are focused on is also one that has a great thesis for the role of Africa in the future. Currently, Africa holds 60% of the world's uncultivated arable land, and only 6% of Africa's cultivated land is currently irrigated. And this land only averages approximately half the yield per hectare compared to the global average. In Rwanda, there was actually a 2018 study done that showed that 45.5% of vegetables grown in the country were lost post-harvest and never consumed or sold to the end users. But if agriculture is handled correctly, Africa could feed over 60% of the global population by 2050. So by finding countries in Africa that are looking to transform their countries through the opening of their economies to foreign investment and also to improving the ease of doing business, then investors can take an intentional approach to investing in these economies and have an impact into the lives of the local community. Rwanda is one country that has started this process and where we desire to be a positive contributor, which makes it a great investment opportunity for the fund. There are a few additional key reasons we believe Rwanda is an attractive opportunity. Firstly, it has a very well-defined structure for property ownership rights through its system of land mapping, zoning, and ownership. The government also has its own mandate to support a transition towards commercialized farming and have made significant contributions to the necessary infrastructure to support this. In fact, the first fund will be a direct beneficiary of this, as it has been selected as one of the commercial operators allowed to enter a long life lease, I should say, with the government for 240 hectares of their project. Additionally, Rwanda provides a low corporate tax rate as a tax incentive for investment. And finally, it has a high ranking in its ease of doing business at 38th out of 190 economies, and is ranked well for corruption at 52nd out of 180 nations. So we believe that Africa, and specifically Rwanda, provides the Capstone Kinvest Fund with a platform on which to launch its vision to create an economic engine within rural communities, which will eventually transition into a long-term sustainable engine through the transfer of ownership of the farms to the workers themselves.
Thank you, Glenn. It sounds like a really exciting opportunity. So let's switch gears to a different strategy, and that is our Capstone Canadian Equity Income Strategy, which has been trading for about a year now. And what opportunities and challenges has this strategy posed so far?
Yeah, as an individual equity strategy with a value focus on Canadian dividend-paying stocks, the fundamental analysis is not unique within the Canadian marketplace. So although we think we have a great portfolio management team led by Paul Carter, it is our focus on investing in stocks that align with our Christian values or at least are morally neutral, that sets it apart from the crowd. Every new fund or strategy we launch comes with its own set of challenges and opportunities, and this was no different. However, they did take on a unique flavor. This is our first strategy with a specific mandate concerning the implementation of what we call our biblical overlay, which has created its own challenges. Challenges of defining what our biblical overlay is and wrestling with how we apply it in individual stock positions, as it is rarely obvious. It's also the acceptance of the fact that we're not always going to get it perfect, but rather to ensure we make adjustments if and when necessary. We also desire to take a positive approach in the market rather than solely focusing on the traditional negative screening. So if we put that another way, can we find stocks that engage in areas we believe align with Christian values rather than simply avoiding ones that conflict with them? And the simple recognition that just because we don't have it all figured out yet and that we won't get it always correct, that shouldn't stop us from getting started and building it out from there. In addition to the challenges, there have been opportunities when launching a strategy of this nature. It's allowed us to engage with other financial professionals who also desire to see Christians in Canada provide a way to invest in a manner aligned with their values. We have begun to work on finding a way for a fragmented Canadian marketplace dominated by big banks and independent managers to be united together to serve the Christian community in a space that currently has many roadblocks to accomplish this. In addition, this strategy has also provided our investors a platform to have a portfolio that they can use as part of their financial planning solutions and that may align with organizations they may wish to support through charitable giving. One other interesting potential opportunity we are walking towards is to mirror this strategy in an exchange-traded fund to provide an investment solution available to the broader Canadian market in a manner not available today. Finally, we're having the opportunity to work with Christian organizations and individuals to deliver both opportunity and education to those that currently don't consider aligning investments and values in the stewardship of the funds entrusted to them. Although our key differentiator is our biblical overlay, the strategy is still structured with a goal to outperform its TSX benchmark, so can be of value in anyone's equity portfolio. And in fact, as you mentioned in the actual question, we've just completed our first year in the strategy, and I'm pleased to mention that the gross of fees model account for the 1 year ending October 6 was 9%. This compares favorably to the S&P TSX Composite Total Return Index of 4.8 and the S&P TSX Composite Dividend Total Return Index of 3.4.
That's great. Thanks, Glenn. Can we talk about interest rates for a bit? So with the Bank of Canada holding rates steady for now, do you see this as the peak for interest rates over the next while?
I assume from the question that by peak interest rates, you're referring to the Bank of Canada rate versus the broader bond market rates. If so, then peak interest rate would mean the last rate move that the Bank of Canada will make in a particular cycle. And I don't know that we can definitively say that we are there. Although there are many who are willing to make these types of claims, I don't believe I know exactly all the factors involved in the final decision of the bank, and therefore would not be comfortable speaking definitively about being or not being at peak rate. However, I do believe that the heavy lifting is behind the central bank in Canada and the Fed for that matter. So we're definitely close to peak at this point, even if there is an argument that it should currently be at the peak. However, there is still a dependence on the data, and with the slowness of the impact of interest rate hikes working through the economy, there could be continued pressure for the bank to make an additional move. Unfortunately, there becomes a growing likelihood that they go too far, resulting in greater impact on the economy than they wish. But this seems to be the error they prefer to make versus not having moved enough. While we can discuss peak in the context of the central bank moves in interest rate, that doesn't mean we won't see higher rates in the bond markets. Over the last 5 months alone, we've seen longer maturity bond yields rising more as the sentiment has shifted around the economic pullback's timing, particularly in the US, and the expectations that rates will remain higher for longer. The Canadian yield curve indicates this now, with the longer-term bond moving up more versus the short-term ones. So when an inverted yield curve reverts back to its more traditional structure, with longer-term rate bonds having higher rates than the shorter-term ones, this is accomplished either by the short-term rates going down or longer-term ones going up. The short-term bond rates will move down where there is a growing expectation of a recession and the bank's likelihood of reducing rates. Otherwise, if there is some economic resilience and labor strength, then there is an expectation that rates will remain higher for longer, which pushes rates up at the longer end of the curve. So while we may be close to a peak interest rate from the bank, the realities of what is happening in the economy will have an impact on the broader bond market. In Canada, with a slowing GDP, we may be closer to short-term rates moving down if the labor market weakens. In the US, the economy continues to show strength.
Thank you, Glenn. Let's turn our attention now to inflation. With inflation slowing somewhat and interest rates holding steady, we appear to be witnessing a shift in the economy. So what advice would you have for investors who are looking forward?
In Canada, our annual GDP growth rate has been declining for the last 5 quarters. And GDP growth rate for the second quarter came in at 0%, which was actually below consensus expectation. Conversely, the US has seen their annual GDP growth rate rising over the last 3 quarters, with a second quarter growth rate at 2.1%, which matched expectations. Indications are that the Canadian economy is facing headwinds, and potentially the interest rate hikes are starting to show their impact. Global forecasts overall for Canada's GDP growth have not been great, and as things stand currently, I think it is fair to assume that we will face some challenges. The labor market continues to be a key to how well we can navigate through economic challenges, as pressure really starts when people start losing their paychecks. At this time, the labor market continues to hold up, but with pressure on incomes and the risk of corporate pressure from higher interest rates and other elevated costs, there still could be labor challenges ahead. For these reasons, I do think it's a good time to be eliminating personal debt where possible. I don't think that our general recommendations for how to structure a portfolio will change. So a broad-based mix of both traditional and non-traditional investments will continue to be what we advocate for, as there will be risk and opportunity within both sets of markets in a weakening economy. However, if we look at traditional bonds, the interest rates being paid today are higher than they have been for some time. While there is still risk of rising yields ahead, there is a strengthening case to include more traditional bonds into portfolios, particularly corporate credit, but remaining selective will be key in a potentially challenged economic environment. In addition, we've long been proponents of private debt and still believe there are good opportunities in certain private debt investments, which should be taken advantage of. As an example, our private high income fund has recently added significantly to our position in the marine investment we started with last year. This is a market that has historically been recession-proof and has provided consistent performance throughout various economic cycles. So overall, all markets and economic cycles will provide opportunities for investments to perform. We just need to be more cautious in the current climate.
Glenn, Capstone has multiple funds invested in the mortgage lending space. Can you provide comments on what you see going forward in this space?
Yeah, to give context to what I see going forward, it's probably helpful to recognize that the construction and development lending space has faced a number of hurdles over the last few years. We had the pandemic, which included lockdowns, remote working for civil servants, and everyone trying to sort out how to operate within this environment. Then we started to see the inflationary cost pressures coming in and interest rates increasing, causing developers significant challenges with budgets and obtaining financing. And then the problem of the ever-changing government regulation landscape. When we go through these types of periods, there are similar reactions or actions that the market faces. These include the traditional banks and credit unions pulling back or stopping their funding specifically into the sector of the mortgage market. This creates liquidity pressure in the market for both current projects and new projects. This does result, though, in a vacuum for private lenders to come in and take advantage of. In addition, developers with strong credit who typically receive funding from banks now look to the private market, which again provides opportunities to fund deals that private lenders typically wouldn't see. On the negative side, projects at the margins run into headwinds and face challenges with their ability to complete under the original plan. These require everything from a rework of the plan to potentially taking over the project. The last 18 months have been a similar story and has delivered both challenges and opportunities along the way. Today, risk continues to be elevated, as September particularly brought some signs of weakening property demand, and the 5-year bond rates have risen over the last 5 months, putting pressure on mortgage rates for home buyers. So caution with when and where to invest remains critical. We do not think all the liquidity issues and headwinds are in the rearview mirror, and there will be reduced deal flow as only the strongest deals will be offered to the market. Further to these issues, the market still needs to see improved liquidity, as there are still too many providers missing from the lending space or taking a long time to make decisions to put money to work. However, strong developers are still going to build projects that are profitable in the current environment, particularly now that there is some visibility regarding interest rates, the stabilizing of construction costs, and the continued deficit within housing supply. Additionally, certain cities are demanding increased density in certain parts of the city, which can dramatically improve the financial metrics for certain projects. In response to this, investors who are currently lending are being rewarded with a higher quality project, budgets and forecasting done based on the current environment, higher interest rates, and less market competition. Therefore, there is a good opportunity today to invest in new projects that are appropriately budgeted and priced for the current environment.
Glenn, thank you so much for joining us today amidst your very busy schedule, and we look forward to having you with us again soon. And to our viewers, we hope you have enjoyed this quarterly update, and please stay tuned next month for the next edition of Your Wealth Matters. Goodbye for now.
Thanks, Glenn, and bye for now.